Alright guys, welcome back to the channel. I wanted to do a video on some current affairs, the coronavirus mainly, but really how that affects the market and what's going on at the moment, and how some people are able to really make a killing in the markets, and how some people are causing the market to make them even more broke. And you know, the coronavirus is a perfect example, because at the beginning of the year we had World War III, and now that's forgotten. Now we're on to coronavirus, and might I add that the coronavirus appears to be one of the weakest viruses known to man. It's actually very weak virus. And on that subject, just so you know, there is 320,000 viruses that affect mammals alone, okay? Now, measles, mumps, rubella, smallpox, the common flu, the common cold, and if you just take the common flu and common cold, for instance, the common cold let's break it down. Last year, between 2018 and 2019, 61 million people fell ill due to the common flu, okay? Now, out of those 61 million, 627,000 people were hospitalized, and out of those 600,000 people, 62,000 people died of the common flu. Now, that's 2018, 2019. You might say, well, that's, that might be a high level. Well, no, on average, it kills 58,000 people per year. So why am I talking about this? Well, I'm talking about it because the news has an agenda to promote negative propaganda to drive fear into the markets. And this week alone, I've been able to make a lot of money both buying and selling the markets, depending on my passive investment vehicles or my speculative vehicles. But the world's gone mad. There's like 87 deaths in the coronavirus, which means it's very weak. There's like 87 or 70,000 cases, which is a very weak virus. It's only attacking people who are old, who have very low immune systems. And the world's going mad. My friend who runs a good friend of mine runs a martial arts academy over in Dubai, and they've closed down all of the gymnasiums, all of the sports centers, all of the schools. People are rushing out to buy toilet paper because they fear there's a lack of toilet paper and low supply of toilet paper, and they're making the problem worse. There wasn't a low supply of toilet paper. Now they're out there making the problem, creating the problem. Now there's no toilet paper. And the world's going mad. Now, what you have to understand is the masses, whilst the masses oscillate between this kind of animal instinct and have these fear-driven, greed-driven types of emotions and actions, the masters of investing and wealth building and speculation are getting richer. I'm investing more now, at the start of 2020, and I did predict this earlier on last year. I said 2020 we're going to see a massive transfer of wealth from the people who have got no idea to the people who have sussed it out, and that's happening. We kicked off 2020 and I've put more money, I've allocated more of my investment account into passive investments since 2009, so 11 years. And I've also made a ton of money this week shorting the euro. I saw the exhaustion following that hype of all this news. I saw the level that we tapped out at that 108 level, bounced off of that as predicted. I waited for the rally. I saw the exhaustion. I saw the deceleration, and I shorted that and made a ton of money in 2 days. So that's a short-term play. In terms of long-term plays, I'm plowing as much money into investments as I possibly can. You know, you've heard the phrase, save cash for the crash. That's what intelligent investors do. Warren Buffett's sitting on something like 127 billion to throw into times like this when you can get bargains. Bargains everywhere, right? And I've just invested in a new startup tech data company. I've gone into business there. I've put a load of money in that. I'm putting money everywhere now because I'm getting the best deals. I'm getting the best buy-in. So when you are not controlled by the oscillations of these emotions and the propaganda in the news, that's when you're able to make intelligent decisions and be consistent. So the purpose of this video, what I'm going to do in this video, I'm going to share with you 6 insights that I think are one of the biggest causes of people not succeeding at investing and speculation and trading. And then I'm going to give you 15 tips that you can go away and instantly use to become better and more successful in your investing and trading. So before we get into those, let's get into the 6 things. So the first one is timing the market. See, when you focus on trying to time the market and get in at the right point, that instantly removes consistency from your trading. Intelligent investors know that they need to remove any emotional attachment to investing, and the best way to do that is to regularly buy the entire market, okay, at regular intervals, and they don't have any thought process that goes behind it. We're talking low risk, passive investments. They just buy and buy and buy and buy, and they buy like groceries, not perfume, as you've probably heard Benjamin Graham say. It's a quote from Benjamin Graham, who's Warren Buffett's mentor. Buy your stocks like groceries, not perfume, and that means buy them regularly. Don't be picky. Buy the whole lot and buy them every month, every month, every month. And by doing that, you benefit from the cost averaging, okay? So the cost averaging of the market, which means basically the mean growth of the market over time. And you're not concerned whether it's up or down, you're just buying, 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 not trying to time the market, but instead spending time in the market. The next reason people don't succeed is diversification, okay? The best passive investors in the world, they don't concern themselves with a particular company or a particular sector. Instead, they just buy the whole lot. They buy all of it. They buy all the companies, all the sectors, and they own little pieces of all of that to diversify across multiple sectors and multiple companies. So they don't care if the tech sector takes a little dip. They don't care if there's a a pharmaceutical industry that takes a dip. They're just buying the entire lot so that diversification allows them to not concern themselves when a particular sector goes down, and they're certainly not putting all their eggs in one basket with one particular company. They don't care. They buy them all. The next problem is shiny object syndrome. I've spoken about this many times before on this channel, but it's this kind of phenomenon where they're constantly in pursuit of the next best system, the kind of zero cost system. And what they're trying to do is they're trying to avoid pain and seek pleasure constantly. Now, there's a part of our brain, the oldest part of our brain from an evolutional standpoint, is called the amygdala. And the amygdala is there to stop us to keep us surviving, basically. And what we know about the amygdala is it will always avoid pain before it seeks pleasure. So if you imagine back in the caveman days, when you're a caveman, and let's just say you've gone for a walk and your cave is 100 meters away, and there's an apple tree 100 meters away, and then there's a lion 100 meters away. Okay, what you will try to do is run back to the cave to be safe from the lion before you go 100 meters to the tree to get an apple. And that means that you want to survive more than you want to have pleasure, which means from an evolutional standpoint, we are more fearful than we are greedy. Now, why is that important? Well, that's playing out this week in the markets. That is absolutely what plays out in the markets. That's why we're able to exploit those emotions on graphical representations in the market and make money. But by chasing a shiny object syndrome, instead of looking at their own system and refining that and tweaking that, they think that the grass is greener on the other side. And the grass isn't greener on the other side. It's just the people with green grass have watered it and nurtured it and made it flourish. And that's what you need to do with your system. Chasing one after the other is never going to make you money. It's going to end up in 8 years' time, 10 years' time. You're going to be looking at this video going, oh, I get it now. All right, the next problem is the lack of trust. Now, I understand this one to a degree because the financial industry is rife. You just type in my name into YouTube or into Instagram, you'll see a ton of fake accounts that have tried to jump on the bandwagon, selling some crappy get-rich-quick scheme in my name, and it's awful, right? And there's fund managers out there that are taking people's money, investing it, and not getting a return at all. They're taking their commissions, and the only people getting rich are the fund managers. The financial industry has been rife with a lack of trust for many, many years. But what I mean when I talk about trust is when I talk to people about how I invest, they usually say, well, if it's that simple, why isn't everyone doing it? And my answer is, no, seriously, it is that simple. It really is that simple. There's an interview that Jeff Bezos did with Warren Buffett, and he asked him, he said, look, why, if your method of investing is so simple, why doesn't everyone else do it? Because you're a billionaire. And Warren Buffett basically said, no one wants to get rich slow. And it's all to do with the fear and greed. It's all to do with avoiding pain, seeking pleasure, having that mixed out the wrong way, and trying to go after something that's going to give them quick gratification whilst avoiding risk the whole time. There's always going to be some kind of risk in investing, and there's always going to be costs associated with it because it's a business, but there's ways and means about going about it to build sustainable wealth through both low risk passive investments and high risk speculation. All right, the next one is personality. Some people like to be right more than they're wrong. Some people are okay being wrong more than they're right as long as the reward to risk profile is stacked in their favor. So it depends on your personality there. Also, some people like to have more opportunity. They like to feel active because particularly when you go from having a normal job, okay, and then you go from having an active job to living off of investment returns, whether that's semi or fully, you will, even if you partially replace your income, you're still working less. So you're starting to develop an income without being active, and that can feel quite unnatural at times. That's when people tend to realize that they've got that in their personality and they want to actually do something. So they're okay being a bit more active in the markets, even if it means they're going to lose a little bit more money and their returns won't be as high enough. They just know that they're going to be a bit more active and they're going to feel a bit more comfortable doing that. But people don't do this, and what they do is they don't build a system to suit their personality, and as a result, they end up losing money because they're trying to do something that's completely against their own intuition. All right, and finally, lifestyle. Okay, so similar to personality, lifestyle. People try to build an investment system and a speculation system or trading, and they try to force it into their life and try and force this consistent system into their life that doesn't suit their life. So they set themselves up for failure. They set a rod for their own back. They're trying to, push a system into their life that means that they need to be at the charts at school run, or they need to be tracking the news for their investments, or looking at their stock screeners in the middle of summer holidays, or and they're doing chores, or they're in a meeting at work and they're meant to be placing their investments, and it just doesn't work. Okay, so instead of doing that, the best thing to do is to build it around your current life and then adapt as you start to see the returns, and you can start delegating other stuff and do more of the investing. So forcing an investment system into your life and a strategy into your life without taking into consideration what your day-to-day looks like is a recipe for disaster. All right, so those are the 6 things. If you like that, give this video a like, put a little comment below if you can think of any more. I'm giving you the kind of top 6 obvious ones. But now I'm going to go through 15 steps that you can take in order to immediately implement and improve your success in investing and speculating. So the first one is to set up regular automatic transfers into an index fund. Okay, I'm not going to go into too much detail on that. I could talk for days about this stuff, but go and research it. Go and look it up. Speak to a broker. Talk to them on a level that makes you a professional, not some Google search or a little YouTube search or in a forum and getting Pip Daddy's opinion. Go and learn how to set up automatic transfers into low-cost index funds. Number 2 is look up the phrase cost averaging. Okay, look up the phrase dollar cost averaging, pound cost averaging, time diversification. Go and research those terms and it will open your eyes to what I said about buying the market regularly. The next point is to go and study the greats like Benjamin Graham, Warren Buffett. Go and read Intelligent Investor. The link's below this video. Go and read that book. You'll see quite how simple that those guys the best investors in the world, how simple their systems are, but how they've stood the test of time. Go and read those books, it will blow your mind. The next thing is learn how to read a financial statement. Okay, it doesn't take long to learn what all those mean. Okay, there's 3 little statements that you need to learn. Go and learn them. Go and understand how to read them. There's so many business owners that they've been running businesses for years and they still don't know how to read a financial statement. It blows my mind, because the moment you understand how to read a financial statement, the moment you develop a massive edge in your own business. You can go and look at stocks differently, companies differently. You can look for investment differently. You understand what people are looking for in your business. You understand what a healthy business is. But not only that, you can go and understand what you're doing, or the fundamentals of what you're doing, when you start looking at other companies to invest in. Then once you've learned how to read a financial statement, you can start understanding how to identify undervalued stocks. You're going to see when those stocks are undervalued and what makes them attractive and what makes them a good investment. So until you've done those things, you'll never be able to do that. The next point is to only invest in large cap stocks. Okay, so go and look at some large cap stocks and only invest in them if you are happy to hold the investment for a minimum of 10 years. Okay, so not looking to, the reason I say this is because you shouldn't be buying a stock to then look at the chart price every single day, every week, every month. You want to just buy it with the mindset that I've done enough research on this company, I understand the company, I know what it's about, the product's simple to understand, I use it myself, I'm happy to put my money into this investment, and I'm happy to not even check the charts for 10 years. Until you can do that over one company, you shouldn't be investing in it. All right, the next thing is to look at your investment account as 3 sections. Okay, so you have a buffer of cash, okay, and then 3 sections should be low risk passive investments like index funds, buying the whole market regularly, low risk, lower return, but low risk, low effort, low time. The second part of the investment account should be geared around picking larger cap to medium cap stocks, where you're taking a portion of money, looking at a stock, understanding how to read the financial statement, understanding how to identify if it's undervalued, understanding that you're happy to hold it for 10 years, putting some money into it, and that's your stock side. And then the third section of your investment account is speculation and trading. That's where you go and buy fine wine, property, art, classic cars, forex market, stock market. That's where you're trading, you're getting in and out, okay? And if you can set up your investment account that way and build a sustainable investment structure, you're going to have success. And the reason you'll have success is because the higher risk stuff at the top, if that crumbles or you take a big hit, you've got the padding of the low risk and then the medium to low risk investments to back you up. All right, the next point is to learn a trading strategy. Okay, so if you're going into speculation to accelerate wealth, learn a strategy. Okay, there's hundreds out there. They probably all work. You've just got to go and learn them, test them, go and build it, make it your own, go and verify it, and understand the ins and outs of that strategy. And then once you've done that, the next point is to treat all of this like a business. Okay, I've said this, I've lost track of how many times I've said this, but treat it like a business. If you're a trader, if you're an investor, that is an income, a means of income. Whenever you're bringing an income in, that's through a skill, you're beating the market using a skill you've developed, that's a business. And the way that you generate consistent profits is through a policy, a business trade plan, where you go, if I do this, we generate a profit. And if you're not treating it like a business, you can't possibly expect to make consistent returns. All right, the next point is don't overcomplicate it. All right, I see many people try and add indicators, try and look at too many things at once. All the complexities get out of hand. They look at too many markets, too many tickers, too many stocks, and it gets way out of hand. It's much better to control your employees. I look at them as my employees. If you started a business today with 20 employees, your business, you would have no control there. You wouldn't be able to manage, let alone micromanage anyone. You wouldn't see who's turning up late, who loves to lay in, who misses the bus all the time, who's stealing, who's sleeping together, and who's death by 1,000 cuts, I call it. You wouldn't be able to see that. It's much best to go into one, understand that in and out, move on to the next, micromanage that one, move on to the next. Don't overcomplicate it. The next step is to go and test historical data. I always go on about back testing, but look, the data's there, the charts are there. We've got historical records of how these things have performed. If you're going into speculation, go back 5 years and see how that strategy has performed before you even spend a penny in the markets. You don't need to spend a penny before you have a system that's profitable. You can just go and test it. Why don't people do it? Because they can't be bothered. But I'm telling you, the people that do have the mindset to go forward, verify that system, and fly out the gate. And then that brings us on to the next point, which is applying a money management system. Once you're profitable, then you can start to look at applying a money management strategy that will allow you to increase your position size, decrease your position size, exploit those winning streaks, and protect those losing streaks. But too many people try and do this straight away. If you're going to apply a money management system to a system that isn't profitable, then it's like throwing fuel at a fire. You're not going to do very well, you're going to end up blowing your account, and it can actually accelerate you blowing your account. It can have the reverse effect. What you want to do is prove that you've got a profitable system, prove to yourself, go and trade it, make sure it's profitable, then apply money management, and then you can accelerate. And then once you're doing that, just focus on the process rather than the outcome. And what I mean by that is the outcome's inevitable, okay? People can become successful traders. The problem comes when you're focusing on instant gratification rather than becoming a little bit better each day, a little bit better each day, a little bit better each day, and refining your edge. What you don't probably hear a lot of traders tell you is as soon as you've developed an edge, it's deteriorating. And it's a continuous cycle of improvement to refine it, to revise it, to optimize it, to then go and test bits of it again, and then bring it back in, and then learn and adapt. It's not you're just not going to get the result that you want straight away, but it's inevitable to get that result if you just focus on bit by bit by bit by bit by bit. And before you know it, you'll be a successful trader. And another thing that can help with that is just accepting a time frame or a realistic time frame of learning. So don't try and say, oh no, coronavirus has come, I've got to learn to replace my income in the next 6 months. Say, do you know what? I'm going to set aside 12 months, 18 months to learn how to invest and trade, and set yourself almost like an apprenticeship where you're just going to go and learn how to invest and trade, and you're going to do it for 18 months, okay? And what that does is it takes all the time pressure off. You've just accepted the process. You're enjoying the process. You set up your diary, you structure in your learning time, you go and you book that in, dedicate that time to working on investing and trading, and after a while, it will start to be natural. And in 18 months' time, then you can consider, you say, right, in 18 months, I'm going to consider applying some money to this. Just do that. What's 18 months, really, in the grand scheme of things? Nothing. We're 2020 now. In fact, at the time of this recording, we're in March 2020. Quarter one is almost done, and it feels like yesterday that we just went into 2020. So set yourself a goal. Next thing is, once you've got something that works, just leave it. Don't jeopardize it. Don't try and break it. Don't try and force it up. Don't try to break it. Don't play with it. It works. You've put in all that work to go and test it and verify it, and you're trading live. You've spent all that time and effort and money. It works. Don't break it. Just go through, trade it, give it time to flourish. Maybe 6 months, give it a review. Not a harsh review. Don't try and change anything drastically. I always give the analogy of heating. When you turn the stat, turn the heating on, whack up to 30. Turn the heating off, turn it down to 0, up to 30, down to 0. That's not how heating should work, right? Optimize it, find the temperature you're comfortable with, and then leave it, right? Same for your trading and investing. And then finally is the ability to develop the skill and the habits that will allow you to stay grounded, neutralizing fear and greed so you're not oscillating in these animal emotions that have got people running around threatening people with a knife for toilet paper, which I saw in the news today. That is animalistic behavior. Intelligent investors, sophisticated investors don't do that. They stand back. They can see more than 2 feet in front of their face. They're not running around in fear and greed and scarcity. They've saved the cash. They're poised. They're ready. They're taking advantage of all of these moves in the market. And if you carry on being driven by fear, the only people that are going to benefit from that are the intelligent investors like myself and like many of the other investors that are saving cash for the crash. The way that you can do that and manually do that is to review and optimize your system. So review your own system. Make sure that you're writing down and journaling every trade, every investment you take, how you felt emotionally, why you took it, why you bought that stock, why you took that trade. If you made a mistake, write that down as well. Read it back. You're not likely to do that again. And just keeping a journal will allow you to optimize without being brash. Okay, so that's it for the video. I hope you found this valuable because you can probably tell by my voice, I'm quite passionate about this. I've worked with thousands of traders and investors now. I've also worked with thousands of entrepreneurs that earn a lot of money and they have the problems when it comes to investing their money as well. So if you did get value from this, I'd really appreciate it if you gave it a like and comment below. I want to hear some of your comments on this and I will engage in the chat down there. But also share this with people that you think need to hear it as well, especially your teachers, your parents, because I know that they'll have different opinions. But that's it for the video, guys. Hope you had a good one. And if you want to learn any more about this, the links are below for my Tiers of Freedom program and my Tier 1 trading program as well. So till next time, take care and I'll see you then.
Everyone wants to live an inspired life, yet so many people search for happiness following the footsteps of peers and taking advice from people who have different values and outcomes to which they're searching. There are people born into wealth, graduated from the best universities in the world, and there are people who have none of that and yet are living extraordinary lives full of fulfillment and reward. The purpose of this is to share insights and strategies that allow you to question the status quo and think freely, so you can design your life and be who you want to be. We get one life. Time is our most valuable asset. I believe that when we're free and able to focus on meaningful work, we become better human beings. This is always free, and I'm your host, Jason Graystone.